beta and standard deviation are most important to pay attention to when you're looking at actively managed funds. And let's drill that down to large cap actively managed funds. One of the interesting takeaways from the year 2024 was that a lot of actively managed funds managed to beat the benchmark. This is not something that they've been able to do over long periods of time. And indeed, over the last 1 year, they haven't managed to do it again. The question that we're asking is one that has been asked repeatedly. Should you opt for passive? But we'll go one step further. Should you opt for smart beta in the large cap space? And is that better than passive and active? Rushabh Desai, founder of Rupee with Rushabh Investment, joining me right now. Rushabh, thanks so much for taking the time, and happy 2026 to you. First, the actively managed large cap funds, how many have actually managed to beat the benchmark of the last 1 year?
Alex, thanks so much for having me on the show. Happy 2026 to you and your team as well. See, the data looks very interesting. What you clearly said was in 2024, active large cap funds outperformed. The answer is a yes, because 2024 was the year where we saw a phenomenal bull run in the Indian equity markets, right? But this wasn't the case in 2025, Alex. So I pulled out some very interesting data. Point-to-point returns on 1 year, 3 year, 5 year, and 10 years, Alex. And I compared the returns of all actively managed large cap funds versus Nifty 100 TRI index, which is the benchmark. So on a 1 year returns basis, which is from 1st Jan 2025 to 31st December 2025, 97% of actively managed funds have actually underperformed Nifty 100 TRI index. Now we look at the 3-year returns. The 3-year returns have been quite good. Only 37% of the actively managed large cap funds have underperformed. But again, on a 5-year and 10-year returns basis, the scenario looks really very bad. On a 5-year returns basis, 67% of the funds have underperformed Nifty 100 TRI. And on a 10-year returns basis, 87% of the actively managed large cap funds have underperformed the Nifty 100 TRI index. So from short to medium term perspective, it is understandable for active funds to underperform, but it is absolutely unacceptable for funds to underperform on a long term basis, which is the 10-year segment, which is the 10-year returns basis.
And why is that? In certain time frames, Rushabh, the argument has been made that it was concentrated stocks that have done well, right? Index heavyweights. You had those periods of Rithik stocks that did particularly well. But it's not necessarily always the case, is it?
No, absolutely, you're right, Alex. See, there are two specific reasons for this why I feel that the funds have underperformed. One is that lack of appropriate allocation towards outperforming stocks and sectors. This is number one. And second, most importantly, is that lack of portfolio churn in this dynamic market cycles. So it's very important for fund managers to be little more aggressive in taking buying and selling calls in the active large cap space, mainly because the universe is limited. The universe is only 100 stocks, Alex. And number two is that the portfolio turnover ratio doesn't seem to be that aggressive. So gone are the days where fund managers could just buy right and just sit tight. The fund managers need to be really very dynamic in taking buy and sell calls. So portfolio churn has to be also quite aggressive in different market cycles. And I'm sure you will also agree that market cycles have shortened initially earlier, and initially the market cycles were quite long, but now market cycles are quite short and very dynamic. So fund managers really need to pull up their socks and churn portfolios quite well.
Yeah, absolutely. And that cost aspect also comes into play, where passive funds are significantly cheaper, and so that reflects in the return profile as well. And so therefore, simply put, if you had put money in the Nifty 100 or a combination of Nifty 50, Nifty Next 50, you would have actually beaten most large cap actively managed funds over the course of the last 10 years. But what about smart beta funds in the large cap space? What are the options, first of all, Rushabh, and have these done better?
Alex, number one, to answer the second part of your question, smart beta large cap funds have definitely done way better than active funds. There are 13 smart beta indices, Alex. Namely, like one is alpha, second is low volatility, third is quality, equal weight, value next 50. Then comes a top 10, top 15, top 50, top 20, and then lastly comes the 100 equal weight. So if I pull out the data on 1, 3, 5, and 10 year return spaces, similar to what we did, the exercise what we did for active large cap funds, uh, you will be quite shocked that on a 1 year returns basis, 40% of the smart beta indices have outperformed Nifty 100 TRI index. 3 year has been 80% outperformance. 5 years has been again 80% outperformance. And 10-year return basis, 90% of the smart beta large cap indices have outperformed Nifty 100 TRI index. So if I compare smart beta indices to active large cap funds, smart beta indices has outperformed hands down, Alex.
Yeah, and there are some that have outperformed in practically all time frames. And let's be very clear, we are not talking about the broader market, relatively speaking, smart beta funds. We're talking about specific large cap smart beta funds, and something like a low volatility fund, the Nifty 100, something like an equal weight Nifty 50, which removes the effect of the heavyweights, something like a top 15 equal weight or a top 20 equal weight have all managed to beat. So what is your suggestion here to this point, Rushabh? The predominant view has been that for your large cap allocation in your core portfolio, you should anyway look at passive because it's difficult to beat passive in the active space, right? Are you
Yes,
going to change
absolutely.
that to say that you can do a combination of passive plus smart beta?
Let's keep it very simple. If someone who does not understand smart beta quite well and is getting confused which product to select, then just stick with the simple traditional index fund, which is either the Sensex plan or the Nifty 50 or the Nifty 100. Okay, and if someone understands how to cherry pick the right smart beta product, then my inclination is towards the smart beta segment, because the data clearly says that smart beta has actually managed to outperform the Nifty 100 TRI, which is the traditional large cap index. I'll give you one more very interesting data point, Alex. See, the active large cap funds have outperformed anywhere between say 0.7% to 1.5%. This is the alpha or the outperforms active funds have generated. Okay. Now, if I compare this with the large cap smart beta indices have outperformed anywhere between 1.1% to 3.5%. So the outperformance rate, the outperformance range of the smart beta indices has been much more higher compared to the active large cap funds. So if your portfolio is skewed towards value style, then you should go for a growth oriented smart beta product. And if your portfolio is skewed towards growth oriented products, then your smart beta should be a value index, Alex.
Okay. It's been something of a mistake on my part. I've, at this point, Rushabh, assumed that everybody understands what smart beta is. But if our viewers have stayed to this point, and if some of them have not understood what smart beta is, let me take a moment to explain it to you. You have these passive funds, right? Or you have these indexes, something like the Nifty 100 that Rushabh has been speaking about. And then what you do is you layer a factor on that. So in this case, for example, if I look at low volatility as a factor, then you will rank the scheme and you will say the top 30 based on this factor out of 100 based on low volatility. That means that the least volatile stocks out of these 100 will form a part of the index. And then the scheme actually allows you to invest in those 30 stocks. This is something that gets reviewed generally every 6 months, and it is something that therefore gets cycled every 6 months. So it's not something that has an active intervention, but it is a mid-step between actively managing a fund portfolio and a passive, where an index allows you to invest in a select number of stocks. It's basically putting one or more factors onto an index and allows you to have a certain bent to your investing style. Rushabh, I hope that has answered any questions that people might have had, but a very quick last point. We've talked about the relative outperformance, and that kind of captures the cost as well. But is it true that broadly smart beta funds are relatively costlier than passive and less costly than active?
See, the active funds will be comparatively more costlier in terms of expense ratio. Depending on the AUM, the expense ratio will differ. But if I compare, smart beta expense ratio will be 1% and less than 1%. It's not going to go more than 1%. But on the other side, actively managed large cap funds will have expense ratio in a regular plan anywhere between say 1.5% or say up to 2 or 2.25%. But smart beta index funds will definitely be much lower, which will be 1% or less than 1%.
Okay, all right, that covers it. Rushabh, thanks so much for taking the time and for speaking to us today. Fascinating conversation.
Thank you so much, Alex.
That brings us to the end of this edition of Your Money Matters. Tell us what you think and what you'd like to hear about. This is NDTV Profit.